Income tax 2020, tax software example, exception for rental real estate with active participation. We'll also take a look at some of the income level phase outs with regard to the ability to take the loss related to active participation and rental property against active income. Come in, relax with income tax 2020. Here we are in our Intuit tax software. You don't need the Intuit software in order to follow along. However, I do think they have a 30-day free trial, so if you can get access to a promo version or a demo version of it, it might be a good tool to practice with. We're going to be taking a look at the Form 1040 and the Schedule E. We'll be going back and forth from the data input to the forms so that we can run different scenarios, the tax software making it easier to do so. We're going to start off with the Form 1040 single filer Eric Smith, living in Beverly Hills 90210, 100,000 of the income for W-2 wages. We're focused down here, line 8, which is coming ultimately from the Schedule E, the 30,000. That brings us up to the total income of the 130, adjusted gross income 130, standard deduction 12,004, and that has a taxable income of the 117,600. Now we then see the Schedule E is going to be here, and we currently have at the bottom line 30,000. That's going to be the income. That's what's rolling in then to the Schedule 1. Schedule 1 is coming from the Schedule E, as we can see here on line 5. That rolls down to line 9, which then pulls over to the 1040. Now, of course, what we're concerned here is usually when we have a loss. If we take a loss against that 100,000, and then we'll add like the income limitations if we have a loss and consider them for married, filing joint, as well as a single status. So if I go back on over now note if they are not actively participating, then you're going to be subject to those passive activity losses again. So if we put the loss down here and I say, okay, let's say we had that $10,000 loss again. So I'm going to say 60,000. That's going to result in a $10,000 loss. And we said that they did not actively participate, and go back on over. So we've seen this in prior presentations, so I'll do this a little bit quicker. And so we've got the loss. It's here, but it's not pulling over. So we got the 10,000 loss, but we don't get it because they're saying they didn't actively participate. If they did, or the taxpayer did actively participate, then we may be able to get access to that loss and take it against the W-2 income. There's the 10,000 now that's been released. You can see it here on the 1040 then. We have the 10,000 now being taken against the 100,000 active income from the W-2 income. So that's what we would like to do if we have the rental losses, take them against the active income if possible. So if we go back to the Schedule E, we note that it's limited then. If I make the loss back up and say this is 80,000, it's going to be limited. So I'm going to come back on over here, and it caps it at that 25,000. So now we have a $30,000 loss. It got capped at 25,000 due to the passive activity rules, and that adds the Form 8582. So here's 8582, which is applying out the passive activity loss limitations, limiting the loss that we're currently taking to that 25,000, which is then rolling forward to the first page of the 1040. There's the 25,000 rolling up. So now let's consider what would happen if our income goes up. So we've got these income limitations. What if we go to the W-2 income and say, well, let's say I went to like my W-2 income here and say we had, 200,000 of other income, and then I go back on over to our forms, and now we don't get the loss anymore, right? We don't get the loss because we had that it basically phased out to nothing. So if I go then to the Form 8582, we got the 30,000 loss. And it's over the threshold. Our income is over the threshold to be able to take it, so we get nothing there. And that basically happens at the 150. So if I made this 150,000, then for a single filer, it's been wiped out here. And once again, nothing's happening for the loss. Loss is not pulling over, even though there's active participation. Now, if we go in between here to say like 120,000, then we're going to go back on over and say now we're getting 15,000. We're getting part of it. It's starting to phase out. So I won't go over, the calculations for the phase outs, but you're going over 100,000, then you could be subject to basically the beginning of the phase out that's going to be happening, and your loss, which could have been up to the 25,000 if actively participating, is now being limited. You can see the calculation, the 150 minus the 120. Now you got the 30,000 and you're getting 15% of that. Now you would think what if they were married here? Would that have any adjustment on it? Let's just check that out. If we go, okay, well, what if I say they're married? They go from single to married. So Eric got married again to Jane. And then if I go back on over, now they're a joint filer and they're still at the 15. So it didn't affect the phase out. You would think, you might think, well, if they were married and single, that it would double, the double amount of income they can have to basically get the 25,000. No, but there is an impact if they file married filing separately. I won't get into that, but remember that's kind of like the general exception to the rule. So we got the same kind of calculation down here for that 30,000 and 50% of the 30,000.